China has now become the physical dog wagging the COMEX tail.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money, and this is the show that goes beyond the headlines to uncover the truth about the precious metals industry with world-renowned whistleblower and industry expert Andrew Maguire. And this week, we're going to be this week we're going to you, the Live from the Vault community. It's going to be a fun show. So let's head over to the UK with the one and only Andrew Maguire. Hey, Andrew, look, there's so much to catch up on since our last episode. It seems so long ago, but it's only 2 weeks ago. And we've compiled, again, another round of Live from the Vault community questions, which you have distilled, down into some bullet points. Can you kind of run through some of these questions for us on this special edition of Live from the Vault?
Yeah, great to be with everyone. And thanks for the questions, guys. And so, obviously, it's been a long time since we've actually had people coming in with questions. So we'll try and get as many in as possible today. But next week, as Shane will outline, is that we're going to get all your questions together and pick the question of the week. Because the thing is that there's so much going on right now. I think as we record this episode, of course, we've got a big smack going on and people want to know about it. So, obviously those questions would have come in and they wouldn't incorporate that. So I'm going to get those in as well. But look, there's a whole bunch of real bullet points, as Shane says, that I really want to weave into these questions. And there's a couple of questions that fit nicely into this. So the bullet points really are, and I think, these are the subject matters. Gold continues to rally without participation from Western investors. Now, obviously, we see a little bit of a pullback. This is not a serious pullback. This is part of the process. The next bullet point is COMEX is becoming a price taker. Yep, and we'll go through that. Also, another one, the non-SWIFT BRICS-centric de-dollarizing process moves to the next stage, and by no coincidence, it jives with the 1st of July Basel III compliance date. Another one, the PBOC has guaranteed gold investments will appreciate due solely to price appreciation. That has to be appreciated. And the other one really is repatriate before you revalue. So we're going to weave all these in, but following our last market episode, that was recorded on the 30th of April, we've evidenced some very large tariff-related volatility. But as central banks are strong price insensitive buyers, they'll just buy at whatever the price. The sell side of this volatility that we're currently witnessing, it really is driven by speculators who are merely racing from pillar to post. They're hopping into safe havens, better buy risk, and then sell gold and bonds, and versus the risk markets, basically, which is what we're witnessing right now. And it's this highly leveraged price sensitive speculators that drive this short-term volatility we're witnessing today. And let's start by connecting just some of these main bullet points, and that under the short-term chart chatter that we're seeing here are driving a series of higher physically supported stair steps. So Shane, let's start with with why gold continues to rally without participation from Western investors. So while Asian ETFs exploded into all-time highs in April, now April alone exceeding all of 2024 demand, when weighing up Western demand as a percentage of BRICS-centric physical demand, so one's paper, one's physical, when you weigh that up, the absence of sufficient Western speculator gold market participation continues to actually limit the scope of COMEX siloed, officially orchestrated rinses, of which we're seeing today. Now, while we've just evidenced another round of the ebbs and flows of tariff uncertainty, ultimately this lack of easily flushable COMEX-centric spec open interest, as what it is doing is setting up a perfect scenario for gold to continue to build on its globally determined, physically supported higher stair steps. Now, drilling down, while the PBOC exchanges dollars for gold at every global AM and PM fix, because that's the benchmark where you need, as an auction, you need to have an auction price when you're buying in that kind of size. And so, but they're very disciplined they also know these COMEX-centric events, such as non-farm payrolls, FOMC, options expiry events. And while they're insensitive to price, they use this paper-induced volatility to load up official monetary gold reserves without driving the price higher. In other words, they're alchemizing dollar price paper gold into fully paid for physical 400-ounce bars flowing out of London, unrecorded, and that doesn't require reporting requirements, and a lot of it doesn't appear even in the customs data. We once went through how there are something like 40-something custom brokers exchanges, and this shuffling gets deliberately lost. Also, when the generals buy, and generals control a very large amount of gold, official gold reserves, none of that is reported. That is military. That is what you would call secret. Now, I'm going to start to record a little section here to really explain things. So a quick look at the charts is probably the best way to illustrate this, but liquidity providers reported very large PBOC buying and insurance-related spot gold demand had accrued at spot 3,300. And these very large orders got filled in large size into the Sunday spec-driven sell-off. But we've just evidenced even larger orders than that getting filled into the PM fix today. With spec long ignition largely used up, it's required naked short momentum short selling to provide the short cover for commercials exposed to an upcoming growing wall of T+1 delivery obligations to actually hedge into. Now, net of this past weekend's extreme tariff-driven volatility, it's also not going unnoticed that directly following the one-day Chinese May the 1st holiday, which is when we saw this dip here, we immediately reinstigated the Asia buys physical, West sells paper gold action, and that was back on the front burner. However, given the West selling is heavily leveraged versus Asian exchanges, actually actively arbitraging the synthetic EFP spread, liquidity providers assess that spot 3,200 is where bullion banks exposed to delivery obligations will be long against the momentum short sellers, and today's fix that came in just below that really is where where those orders started to get filled, and will have driven the next waiting layer of PBOC and institutional buying. Using silver as an example, it's pretty clear that short-term speculator-driven inverse correlation has developed between the risk markets here and gold and silver. But global liquidity providers report a higher physically supported stair step is being established and is just being established today. And because central banks fill only at the fixes, bear in mind you need an auction to fill large size, so that will have actually been settled today and will require those positions to be delivered. And today marked the first gold fix sub 3,200 since the 10th of April. And the filling of these central bank bullion bids will be short-lived. The lows will be short-lived. Actually, this leads us nicely into the second bullet point, which is COMEX is becoming a price taker. You'll look at the chart and you'll go, we're going down. Don't be fooled by today's short-term chart chatter. That's all it is. This is the last kick at the can ahead of Basel III US compliance at the end of this quarter. Now, Western gold investments are largely represented by highly leveraged COMEX futures-driven speculators seeking to track the price of gold. And to do so, they just have to invest really 4%. And this is a derivative position, which is where you just have 4% of skin in the game. And these are cash-settled investments. They're never designed to be delivered. And they're borrowed from the house market makers. Well, do you figure that's any dissimilar to the synthetically structured world of a casino? I mean, the market makers, the pit managers, loan out this fractionally backed gold, silver, open interest, the chips, as we've said, while taking the other side of these bullish or bearish speculator bets. If they're betting against the house, then the house is on one side. If they're betting with against the house, whatever it is, the house is on the other side. Now, these chips, though, think about it. These chips are not exchangeable outside of the casino. So this is why we called it a siloed market, because everything that you're shuttered in, there is no windows. This is why it's so similar to a casino environment. Historically, this highly leveraged gold derivative structure that could be profitably managed in-house and return a standard 95% win for the house and just enough of a 5% win to keep the speculators trying their luck against the house. Now, this is what led the last 50 years of the gold derivative tail wagging the physical dog price. However, as we've been tracking following the BIS, the Bank of International Settlements, reclassifying physical gold as a first-tier asset class, the global gold price is increasingly being determined by competing BRICS-facing physical exchanges. Now, all the BRICS exchanges require that a gold bar has to be bought, titled to the buyer, and then fully paid for clearly before you can ever offer that for sale. And this is how a real supply-demand globally fungible gold kilobar price is determined by somebody who really is willing to sell it for a price or buy it for a price. There's a balance there. Now, physical market liquidity actually has now migrated to Chinese-anchored BRICS-facing exchange. China anchors these exchanges. China has now become the physical dog wagging the COMEX tail, regularly alchemizing the globally underpriced synthetic price, utilizing the backdoor exchange for physical conduit. We talked about it multiple times. It is the way of getting, it's the Achilles heel, it's the backdoor of the COMEX where you can actually convert an otherwise undeliverable cash-settled COMEX price with only a 4% investment in it into a 100% paid for, physically settled T+1, meaning one-day delivery, NSFR compliant physical bar. Now, as we looked at really most recently, I think at last time, a rash of recent calls from technical traders. They're currently calling for the synthetic gold tail to keep wagging the physical dog, and they're having some success today. What they're doing is chasing moving averages, hunting out, are there any longs or shorts that they can garner at these? This is the house at play. Now, and obviously, while they're doing this, they are either disingenuously talking their own book, which would be officials, spinning the idea that gold should retrace to its historical moving averages and trend lines, which really many people follow. But these trend lines are anchored prior to the 1st of January 2023 Basel III, where it recategorized gold as a first-tier asset class. So the old guard are on the wrong side of an increasingly liquid physical market. And they get little wins, and they're right in the middle, but wrong at both ends. But the open interest, as we've just looked at, is reducing into this process, giving them less and less and less bandwidth to be able to do this. Now, these naked short footprints contradict the strong upsurge of physically settled BRICS gold demand. And they're not going unnoticed. And while these momentums are fueling yet another synthetic market overshoot, they've done it to the upside, they've done it to the downside. They're providing a very welcome discount to Chinese speculators. And while central banks are price insensitive, they also lay in wait to aggregate their bids below round numbers, which we've just crossed today, where they can fly under the radar, and they step up, then swapping dollars for large gold purchases. And that's something we're evidencing now.
Hey, Andrew, we had a question here on the exchange for physical process, the EFPs, and how this will be affected into the July 1st Basel III U.S. compliance. Now, this question is coming directly from Lawrence. So let's hear from Lawrence.
Hi, Andrew. In July, we're going to see that the US is going to have to become Basel III compliant with regards to gold. So just wondering what effect or what's going to happen with regard to markets like the COMEX, even the LBMA, the casino chips, the OCC bet clearing. What's going to happen? We're going to see any movement in price. What do you expect the effects to be of this enforced compliance? Thank you.
Yeah, Lawrence, really good to bring this one up, actually. It ties in with one of the other bullet points I actually wanted to cover, which was repatriate before you revalue gold. I mean, that's distilling your question down to really what this boils down to. Due to the fact that the exchange for physical mechanisms has unmistakably exposed the COMEX Achilles heel, and this in turn is connected with the OCC bets you refer to, the Office of the Comptroller bets you actually refer to. I also get a lot of questions asking why the historically siloed COMEX exchange does not just slam shut this Achilles heel, this EFP backdoor, the ability to convert 96% leveraged gold bets into 100% deliverable gold. I mean, that is diluting and undermining the entire casino. Now, currently, the EFP mechanism is slowly and systematically letting air out of trillions of dollars of asymmetrically imbalanced Fed-centric bets against gold. They're largely constrained to how much of this open interest in the COMEX can be offset, and the derivative markets can be offset against a shrinking supply of COMEX open interest. In other words, there's less and less chips in play. And this process is evident by the series of higher physically supported stair steps, forcing the Fed to repatriate gold and pay back these Bank of International settled bets at a series of higher prices. While this obvious exit of officially held naked short bets against gold requires an increasing amount of dollars to be sold against a rising gold price, it's handleable, albeit at a series of higher gold price stair steps as captured over the last 14 months of sequentially higher BIS squaring footprints. Ultimately, this official exchange of dollars for gold enables gold to be repatriated ahead of the necessary upcoming 1st of January Basel III compliance audit, which would be required for the US Treasury to exercise its GRA, its gold revaluation account, which is revaluing gold to market. It's far better to buy back leased swap gold at, say, $3,000 than gold at $4,500 or higher. However, though, to answer the question in more detail, this asymmetrically imbalanced EFP mechanism is directly connected to managing the OCC structure, which you refer to. Now, if there was an attempt to slam shut the EFP backdoor, it would result in a force majeure, which would be trillions of interconnected COMEX, LBMA, and technically NSFR compliant, asymmetrically imbalanced FX gold OCC derivative bets. They'd have to be marked to market instantly, overnight. This is not viable. as it would expose the entire daisy chain of too big to fail taxpayer insured banks to losses far in excess of what could be bailed out into a bid-only global market. We saw a sample of that at COVID, in the COVID market, when the physical market, when the liquidity providers were turned on for physical delivery and they didn't have it. And as we know, every single market-making CME and LBMA facing bullion bank has a straddle footprint in both the NSFR compliant, physically deliverable, 10 times larger foreign exchange markets and the as yet non-NSFR compliant CME markets, which gives them a tremendous advantage. We actually kind of did something about that, explained that last time. Now, our well-connected liquidity providers affirm that the current US-centric haircut that separates gold futures, exchange-traded fund gold from NSFR-compliant gold will have to end on the 1st of July. If it doesn't match the 10 times larger spot gold foreign exchange market price at the benchmark global fixes, then the backdoor EFPs, where it's possible to convert this non-compliant COMEX lot into NSFR-compliant T+1 deliverable FX positions, it's going to be drained, alchemizing what little dwindling underpriced COMEX open interest remains. Now, given the OCC bets are on the Fed's balance sheet and are likely interconnected with rehypothecated US Treasury gold positions, it's better to continue to let the air out slowly and repay it before you revalue.
Hey, Andrew, with that being said, how do you see it progressing moving forward here?
Yeah, Shane, as we've touched on, into thinning out COMEX open interest, forcing the COMEX to become a price taker, the non-SWIFT BRICS-centric de-dollarizing process, it moves to the next stage, and by no coincidence, it jives with the 1st of July Basel III compliance date. And as we've looked at in more detail just 2 weeks ago, China has anchored BRICS payment chains are rapidly onshoring, providing sufficient liquidity to also digitize. And we talked about Glasnev's fully beta-tested, revamped mBridge. We're talking about mBridge here, which is the formalized version of that. And that's the BRICS-facing 40% backed gold currency. So it's been beta-tested by Russia. It's been tested by mBridge. It was hauled back in because of sanctions, but it's on the front burner again. And so due to Russian sanctions, mBridge was actually put on the back burner last year. But the surge of global tariffs equal global sanctions galore. And this puts it back on the front burner. Now, our Asian liquidity providers figure the onshoring of a growing suite of BRICS payment chains will ultimately result in a global physically settled, not T+1, T+0 instant gold price will be quoted and settlement quoted in RMB. If you have gold in the vault and you're shoveling it from across the floor from one vault to the other, and they're all fully paper bars, T+0 is possible. Not going to be shipped anywhere. It's in the vault already. Bear in mind, you're talking about gold that exists. And to facilitate this, Beijing is rapidly expanding its international facing Shanghai Gold Exchange, opening up Hong Kong as the first of several Western-facing Chinese gold warehouses. And this is going to force the Loco London AM and PM dollar gold fix to quote these prices as well. We mentioned that last time, but this is really coming on the front burner now. It's progressing seriously. And these SGE international-facing vaults are not just 100% Basel III NSFR compliant, but as every bullion bar is fully paid for, assigned, and sourced out of physical stock, that is no reason, as I say, it can't be settled T+0 on the spot. And that would set a much higher standard. And it actually means de-dollarization in a big way. There's no friction there. And reestablishing foreign exchange gold, which is supposed to be NSFR compliant as the benchmark that values every other fiat currency, and that complies with Basel III NSFR standards. Now, over the last 2 weeks, alongside loosening import quotas to meet an upsurge of strong Chinese demand, Beijing has announced its intention to open up several international gold hubs, securing its global-facing pricing influence. And while it's so far just Hong Kong has been announced, there are more coming. Now, to answer a specific question from the subscriber Mitchell Lambert.
This is Mitchell Langbert. I have a question about some news I just heard. The Chinese are opening a vault in Saudi Arabia to store gold to allow them to buy oil. Is this true? What are the details? And is this the first of vaults in a variety of countries? Also, what is the implication for gold demand?
Yes, this includes establishing a vault in Saudi Arabia. But our feedback also points to expanding China gold and silver vault network into Brazil, into Mexico, and Colombia. And that's just to name the few that we're getting rumor on, and credible rumor on. And this formalizes what China and Russia have been doing for years already, is providing oil producers the ability to convert a 7-second digital RMB settlement position into gold, into and out of gold. Now, sanction proof. All of these moves are part of a strategic plan for China to stick handle BRICS nations to become the global benchmark price setters for all commodities. Revealing the PBOC has taken its kid gloves off and along with Russia are now in a position to consolidate these BRICS-centric markets. All of the pieces of the multipolar, multinodal puzzle are concatenating ahead of the confluence of the July 1st Basel III compliance and the BRICS July Rio Summit, which is seeking to overcome the threat of, at one point, 150% tariffs on BRICS members who dare to trade outside the dollar. And I've even heard we're talking about $500% tariffs on the secondary on a secondary Russia gold sanction. If they don't come to the table. So then they may come to the table, they may not. But this is the risks out there, so that anyone touching Russian gold could be sanctioned 500% if they want to sell anything to the US. So clearly these things are in play. And the BRICS members have already been threatened with 150%. Now, the digital RMP BRICS payment bridge is not only multinodal, multipolar, global payment tool, it's also a technical carrier of the Belt and Road strategy, fits in perfectly, and enables the build out of the digital Silk Road, but it also provides access to the Northern Sea route. And this kind of leads us nicely to the next bullet point. The PBOC has guaranteed, and this is important, if you remember, we've done episodes about this over the last 2 to 3 years, where the PBOC has guaranteed on several occasions that gold investments will appreciate due solely to price appreciation. Now, that's a major statement to make. And obviously that requires your fingers in the pie. And since a major push by Beijing to encourage citizens to buy gold in 2010, and gold price appreciation statements and actions have been regularly affirmed at every strategic fresh initiative to further open up gold markets to citizens and businesses. And while there were periods when the yuan price exceeded well over $100 an ounce above the COMEX derived price, these Western paper supply-demand imbalances were simply arbitraged as cheaper Western gold was drained into China to meet the real physical demand price. And that ended up dragging the COMEX price higher. And it's so much of that has been missed along the way because people look at the dip and they don't realize that the steady recovery is actually a physical draining of this open interest. And this was of particular note when the PBOC encouraged this very small, less wealthy citizens to open up millions of very small gold accounts. I mean, we were talking about maybe a gram or less, enabling them to swap their, to literally with a click of a mouse to purchase gold. And with that, they essentially guaranteed to underpin a steadily rising gold price. Now, in opening up the Shanghai Futures Exchange to citizens and businesses 14 months ago, on the 1st of March 2024, that was a strategic move designed to raise the value of Beijing's vast gold reserves. The Shanghai Futures Exchange launch was grossly underestimated by the West. And remember, we showed chart after chart after chart of this and the steady price rise since then. It was grossly, if you remember at the launch time, it was grossly underestimated by the West, who relying on, again, historical dollar bond and trend line correlations, they were caught wrong-footed, big time. They were waiting for a historical pullback that never came back. Subsequently, gold has risen as much as $1,500 an ounce from that moment. And right now, by no coincidence, just over 1 year later, in the early stages of the second quarter of 2025, we're witnessing another similarly officially sanctioned, commercially targeted gold buying mandate being sprung on the West. And it's actually, while the bullion banks have woken up to this, very, very few people, and are certainly not the people playing games today in the paper markets, are aware of the physical impact of this. This time, this gold buying mandate is being driven by a directive for Chinese insurance companies to invest 1%. Now think about this, 1% of a 32 trillion of assets into physical gold. And 32 trillion is just the 2003 figure. And I don't want to guess at what it is now, but it's probably more than 32 trillion. So 1% of that, think about that. The opening of the Shanghai Futures Exchange to these insurance companies, and it only happened on the 25th of March, 1 year later, 1 year and 3 weeks later than opening up to citizens. It requires in these insurance companies to swap. How are they going to buy gold? Swap US treasuries for gold. And it's only just commenced. And it's what drove Goldman's 4,500 2025 target. And so and if you think about it, that's about 3,000 tons of unfactored fresh demand at current prices. And that's just with 1%. And the word is it will be increased. Now, that's an entire 1% is 1 year of entire global mine production. And while liquidity providers expect maybe a third of this to be bought and paid for by the end of the fourth quarter of this year, that still telegraphs 4,500 gold price. So in summary, really, China's central bank now dominates the physical gold market, enabling gold price appreciation support to actually continue.
Hey, Andrew, what are you seeing in silver these days here?
Yeah, I understand we had a great question from Lawrence. Can you play that?
Hi, Andrew. You mentioned that the price of gold is less and less influenced as time goes by the COMEX and their shenanigans. But silver's a much smaller market. It's still got massive short positions at the COMEX by the big 8 banks. Can you go into a little bit of detail about the current registered and eligible amounts of silver held at COMEX? And how easy is it still for these big players to smash down the price of silver in their rinse cycles? And, given the amounts outstanding at COMEX, how far realistically lower could you see them take the price? Many thanks.
Well, that's great then, Lawrence. While I do track, this is a specific question, but there's a lot involved in your question. But while I do track the dwindling volume of registered and eligible COMEX data, I don't trust these cobbled together reports at face value. I don't take them at face value. And they pale in comparison to the much larger, massively imbalanced naked short OCC delivery, silver FX bets, the Office of the Comptroller bets that are listed on the quarterly report and are evident. Now, silver is still acting in the same manner as gold did before it became Basel III NSFR compliant. Now, this is to understand what's going on with silver. Before gold became NSFR compliant, it would trade unallocated gold positions, which is kind of like silver now, which could be leveraged hundreds to one times to one at levels that made it actually impossible to deliver upon because it wasn't NSFR compliant. So real physical orders that came in from physical buyers outside the cartel's ring fence, to think about it, 600 to 800 tons were daily settled, cash settled amongst the bullion bank books without any physical, or very little of that physical ever reaching a physical process. And so they would command massive premiums. If you wanted that physical, massive premiums over the spot price. Now, orders over 100,000 ounces commanded premiums of tens of dollars, and in fact, up to $100 higher than spot per ounce. And as we've highlighted in multiple episodes, the moment gold became Basel III compliant, these liquidity providers must have the bullion to deliver. So we know that the bullion banks are long both gold and silver for their own books. So while they can asymmetrically leverage these physical positions that you can see by a short by the eight large banks you refer to, the COMEX net short banks, they actually don't want to be don't want to actually unload or deliver any of this bullion. And with Indian and Chinese physical exchanges sucking up this tail wagging the dog cheap silver supply, we can deduce the naked short element of these bets are sitting on the books of the Fed. There's no compliance officer that in any of the too big to fail bullion banks that would allow a naked short position of that size. These are the positions listed in the OCC report. A lot of this synthetic action is buried in the gold-silver ratio trade, which is currently being unwound from its 120 to 1 all the way up here at, which was the 2020 highs, with the objective of trying to exit this underwater trade as best as possible. Now, currently using gold strength, this has actually now been cut to around plus or minus 98 to 1, which is still exorbitantly high. Now, while silver has been influenced by momentum short sellers crossing over from gold futures, assisted by the related large offside Office of the Comptroller bets that were the official crosshairs being marked to market into the April month low here, and then again into the May 1st low, month-end low, it's aggressively being bought into the dips into spot 32, which is where Indian and Chinese buyers are very, very active. Most liquidity providers see silver sub $38 as far too cheap and unsustainable at current levels. Well, thanks for the questions, everyone. Look, please keep them coming in. I'll try and get to more of them next time, but as Shane says, we'll probably compile them, we'll sit down, and we'll see really what is the top question of the week. In the meantime, though, there is only one question, and that is, how much physical gold do you own now?
All right, that wraps up another episode of Live from the Vault, and a big thank you to Andrew Maguire for sharing his deep market knowledge, and a special thanks to all those questions. Now, starting next week, we're going to pick the question of the week, and why not just look for the link below? We'll include it there. Record your question for Andrew. He may ask your question live on the air, and so that's great from our global community around the world here. So if you're new here, make sure you subscribe. Tap the bell right there if you want to be notified as each episode goes live. And if you've been with us for a while, help us keep spreading the word and give us a like right now and share this episode with someone that needs to hear this information. And we'll be back soon with more truth that you won't find on the mainstream media. Until then, take care.